Why on earth are mortgage rates moving higher as the Federal Reserve cuts interest rates? Sounds very illogical, but I'm going to explain it to you. I have an undergrad and graduate degree in finance, a CIMA designation, a CFP. I spent a decade on Wall Street, and now I run a wealth management firm. So let me help you out on this topic. The first thing, what you're going to take away from this video is a little better understanding of how the Treasury yield curve functions because that dictates mortgages. And then you'll understand why, even though the Fed is cutting interest rates, mortgage rates are going higher. Let's get a little of the jargon out of the way to begin with. When people talk about the Treasury yield curve, it's kind of broken into three segments. The front end or short-term rates, which are Treasury yield rates out to 2 years, the intermediate or the belly of the curve from 2 to 7 years, and then longer term interest rates or the back end of the yield curve. We're going to focus today on the front end of the yield curve and the back end of the yield curve. What you must understand is that the Federal Reserve can only really dictate what happens on the front end of the yield curve. Over here, when the Federal Reserve cuts interest rates, the yields on anything inside of 2 years typically drop. And you'll also see a drop in things like CDs, money market, cash-like securities. The yield on those will drop as well. Whereas the longer end of the curve out here is not dictated by the Fed whatsoever. It is influenced in this function. The back end of the yield curve is all predicated on future growth in inflation expectations. And so what you've seen recently is the Federal Reserve is cutting on the front end, driving front end yields lower. But what that's also doing is bringing down interest rates on things like credit card debt and stimulating people to go out and spend more money. So over here, the inflation expectations have reverberated back upwards because if people can get cheaper money, what that does is sends future inflation expectations higher. You also have inflation literally having reaccelerated over the past 2 months as well, which isn't helping the problem. So now let's get to the mortgage rates. Mortgage rates are all dictated by what the 10-year Treasury yield is at that given point. So that's what we're going to focus on. Mortgage rates have two components. The first thing is the 10-year Treasury rate, which currently sits at 4.78%, and then they add on a spread on top. Now that spread is a function of two separate things as well, the individual's credit risk, and then also how much interest rate uncertainty is currently in the market. Now, typically the spread averages right around 1.3%, but you'll see it's meaningfully elevated right now, 1 full percent above the average at 2.3%. That is a function of a lot of interest rate uncertainty in the market. And that is measurable by something called the MOVE index. Now, you may have heard of the VIX index. The VIX measures the volatility or the fear within the stock market. The MOVE does the same thing with interest rates and the bond market. The higher the MOVE index is, the more volatile interest rates are. And as you see, typically the MOVE index trends somewhere in this 50 to 75 ballpark, but we are meaningfully elevated right now, meaning people really don't know where interest rates are going in the future. And people are also banks. The banks don't know where interest rates are going in the future. So what they need to do is build in a bigger buffer for that of future interest rate uncertainty, because the last thing they want to do is issue you a mortgage right now and a year out from now have interest rates on the 10-year Treasury bump up 2 full percent. That is a loss leader for them. So the reasons that you have more interest rate uncertainty right now, again, are over the past 2 months, inflation went from trending downwards to reaccelerating. That direction is not a good one. The second thing is it seems that the Federal Reserve is totally lost as to where inflation will go in the future. And so therefore, that throws out what they're going to do. We don't know. And then the last one is the incoming president. Donald Trump, a lot of people would argue that his economic policies may be inflationary. As a result of all of that, the reason mortgage rates are increasing are because inflation has reaccelerated over the past 2 months after trending downwards meaningfully. The Fed seems totally lost, and Trump's policies may be inflationary, resulting in a lot of uncertainty about inflation, which dictates the direction of interest rates and mortgage rates. And therefore, although it may be counterintuitive, mortgage rates are going up as the Federal Reserve is cutting interest rates. Guys, I hope this was a little helpful education on mortgage rates and the Treasury yield curve. If it was, please hit the subscribe button. I will continue to put out consistent educational information on finance and investing. Appreciate you guys. Last but not least, here are the fun disclosures. Thanks again, guys. Can't wait to see you next time.